3rd of May, 2023, Wednesday, MAO with Cal once again, guys. USA sovereign risk doubled. Oh my goodness, this is crazy. Just 2 months ago, the number was at this level, now it has doubled. What's trying to say? Meaning that people are getting worried right now. They are very worried that USA may not be able to get out of this. And I've been saying this, recession is on the card. And now I'll tell you, the smart money and the dumb money, their spread itself is getting so far apart, and usually when such thing happen, things will get very, very incredible. So with all this information, you need to watch this video. Let's go. All right, disclaimer apply as usual, and thank you, Ames, for the kind sponsorship. Now let's recap what happened last night. Now the Dow Jones lost 367 points, sorry, and the Nasdaq down by 117, and S&P down by 48. Now this is something that I've shared with you yesterday in MAO. I said that right, most likely the S&P 500 might be going down towards 3960 level, something I forecast last week. And to me, it's all right. This will continue. Now, tonight we will have the FOMC meeting. Now, the thing is this, everybody is kind of worried right now whether they're just debating whether would there be a rate pause, or would there be a rate hike and a pause, or would there be a cut? Now, to me, a cut is impossible, all right, in my opinion. But to have a rate hike and a pause is most likely the thing on the table right now. But if you ask me, I think that they shouldn't pause. There should be a rate hike and a potential rate hike, then a pause. Okay, so to me now the traders' fear is around the banking sector, because obviously the SPDR regional banking ETF dropped more than 6% overnight, and that's something I've been telling you guys, don't buy this ETF. If you want, go short on it instead. I'll cover that very shortly. And of course, now we have regional banks like PacWest, Western Alliance down between 27 to 15%. At one stage is down, these two counters were down by 40% at one stage. Yeah? Now, of course, JP Morgan also had to reback some of their gains because, you know, end of the day, it's still be a liability for them, and it's also be a sort of pain across the board for all the banking sector. So now what is happening is that everybody is watching the Fed meeting today. Now, do remember tonight the announcement will come out tonight. Yeah, so don't forget about this. All right, although it's a 2 days meeting, so tonight it will come up. Okay, so take note of that. Then after that, we have the Federal Reserve Chairman Jerome Powell. He'll be speaking to the press. So usually during that period of time, the market will be very volatile. Okay. Now the thing is, this very important now is that Janet Yellen warned on Monday that US may run out of measures to pay its debt as early as June the 1st. So this is one thing that the market is kind of worried, because we have this current situation where now we need to raise interest rate to curb inflation, but then the banks are having problem because of this, and you're hiking rates, which is the main reason why some of the banks are literally filing bankruptcy. So it's like, what should they do, right? But if they don't do anything else, okay, they let it be, things can get very, very crazy. So to me, more sadly is that they will continue rate hike and then look at a potential rate hike again the next one. That is my personal feel. All right, so if you remember 1 month ago, I already tell you this, the stock market can be strong, but soon the smaller companies will suffer. Why I say that? Because I already tell you guys, very good chance that the treasuries will not be able to facilitate their deals. I said that, I mentioned that Janet Yellen will come out and tell people about the debt ceiling, and truth be told now, it's across all the mainstream media. Everyone is kind of worried right now whether the US will actually raise its debt ceiling, which of course, in my opinion, 100% they'll raise it. There's never seen such thing not happening. In fact, itself, it will happen. But when you do that, right, you're just kicking the can down the alley. And of course, things will get even worse as time goes by. So now we can see that now a lot of mainstream media like Bloomberg says that, okay, US could face economic turmoil if another bank faces collapse. All right, say some of the money bosses in the market. And of course, it's a slap in the face when you see first Big Bank, their slogan is a privilege to serve you, but of course they have literally screwed up many people. In fact, as well, this is going to be bad. Then of course for JP Morgan Chase, they have done a pretty good job to buy over FRB, and of course we all know that the deal was pretty good. All right, it's really, really pretty good deal. And of course they are all looking at other banks right now, like HSBC, will they be in trouble? But I think that those bigger banks are still okay. But to me, when the small bank and the medium bank get into trouble, it's a matter of time the big bank will get it. All right. So the three big banks damages you can see is incredible. Now look at 2008 and 2009, where the biggest one is Washington Mutual Bank, $307 billion. Then we have IndyMac, we have Colonial Bank taking about 25 to 32 billion. But if you put into retrospect, right, you can see this right now, is that the amount of money that in total, right, bank failure, right, during with adjusted with inflation, yeah, you can see that, right, 3 banks alone have basically, you know, covered all the losses created in 2008 by more than 20 over banks. So you can imagine right now, right, if there's any more banks going to go down, right, this will mean that the current crisis now is even larger than the 2008. And back then in 2008, the stock market came down by 54%. So not too sure this time around how much, 100%, but at the moment now it seems that the market is still staying on strong, right? So somewhere is wrong. So first, probably likely the rescue will not be, it will not help the investors, and New York Stock Exchange is to delist the FRB shares later, yeah? So all these are showing you that they are basically doing all the move to get things up and moving. So now look at the SPDR regional banking ETF. You can take a look right now. Then you can see pretty clear that back then that was during the pandemic period, whereby we had that moment, and of course the ETF slammed down from 56 all the way to 28, so down by 50%. But that was done in about 1, 2, 3, 4, 5 weeks. Okay, so where are we right now? We have just lost that technical point, which you can see from very clear. And of course, seemingly now with the volume itself so much higher than the last time, very good chance that this ETF will still go down, and I'm not half surprised to see at 28. Now, once you go to 28, I think that this is a very good time to buy some ETF of this. 28, 25, 22, all these are prices are very good to buy, because I think that that is highly oversold. All right, the last time we saw this is all right, when the market came to this point, it had a rebound, but after that, you can see it gave way. And of course, in 2000, this happened. And of course, that's where the market recovered. So if the current situation right now, if the Fed increasing rates and to combat inflation, I don't think this will be the same. To me, it's all right, a very good chance to see 28 for this ETF in a long haul, maybe 2 to 3 weeks time is really, really possible. All right, so you take note of what I say today. Now, the unrealized gains on investment securities, this is actually followed by FDIC. You can see that the losses is ridiculous. It's really to the lowest level the last how many years? Last 20 years, about 15 years itself. So you can see that the damage is really, really bad. And in fact, the US banking system market value of asset is 2 trillion lower than the suggested by their book. So mark-to-market bank assets have declined by an average of 10% across the bank, and the bottom 5 percentile experiencing a 20%. Wow, incredible. So all this speaks for itself that if there's going to be any more bank crisis, right, this will just keep on going lower, keep on going lower. And with the banks have to notice that this is really impossible to save. Once you pull the handbrake, pull the credit facility, a lot of banks will get it. A lot of middle company, small company will get it. So of course, the opinion is the Fed says, don't worry about the US banks, but should we even believe in them? And I don't believe in them. My hands is up. I don't believe in them because they have said so many things, but we all know that it has screwed up. So likelihood, we just hope that this won't happen, a bank rush to the bank, right? This is something crazy, because if it ever happen again, well, that means that something is as bad as what Lehman Brothers is. And of course, the stock market will really tank, yeah? So let's compare what happened in 2008 to 2023. Quite interesting, guys. This is taken from somewhere else. I didn't do it. Okay, April itself, 2007, we have New Century Financial bankrupted. Then about a few months later, 5 months later, in 2007, the bank runs at England Northern Rock Bank. That means there's a bank run. And then after that, subsequently, Baston collapsed in March 2008. And after that, we have IndyMac, Freddie Mae, Lehman Brothers, AIG, Washington. All these, basically, the effect was very fast, from 5 months, 6 months, to straight away to 4 months, 2 months, a few days, and a few months. Every month, there's a problem. And then, of course, only very late in 2009, March, then the market bottomed. I remember from then on, the market had lost about 3,000 to 4,000 points on the Dow Jones back then. So the thing is this, if you look back again, right, well, we have a very interesting correlationship, because why? We have the Silvergate down, Silicon Valley Bank down, Signature Bank down, and then Credit Suisse went down, and First Republic Bank. So all this looks very, very familiar. And of course, when the big one get into trouble, the rest will actually get to follow. So that's one thing to take note, yeah? What traders you need to watch out for this. All right, one thing that I'm very, very, very concerned right now is the JOLTS. Now, we remember this have been there for a longer of time, 10 million jobs minimally, to the point that I hardly cover. But the problem is this, yesterday, the number went down again. The market was expecting 9.77 million of jobs, but they came out 9.59. Now, do note the previous time they're looking at this 10.4, it came out 9.93, and the market got into a shock mode. And then now again, the JOLTS is now showing lesser jobs available. Now, think about this. If the economy is doing well, would you have such a problem? Number two, is it because the smaller companies, the big companies are cutting down costs? Very high chance, because think about this. If some of the banks, like, some banks are cutting their salary, not cutting their jobs of people, right? You cannot imagine what's happening now to the small and medium company. I think they'll suffer even worse. So to me, it's all right. This speaks for itself that I believe that a recession is coming soon, because we can see that when it comes down low enough, we all know that something is just very, very wrong. Okay. All right, so what am I saying about the US sovereign risk, right? Is this one here, the 1-year CDS, the credit default swap. So you can see back then, right, in 2023, at the start of the year, we have a what we call the 1-year CDS go all the way up from 20. You can take a look from 20, right, from 20 all the way, it shot up to 90. Oh my God. The last time we see this so high was at 60 plus for Lehman, then the US downgrade by S&P 500, then the debt ceiling crisis. All right, then after that, we have the 2016 QT. So all these things they're so terrible right now, right? It's not even near to it for the current market, because now at the moment now all seems good, everything looks nice and stuff. But guys, this is just only until February. This is only until February 2023. Let me show you now the most updated one. Oh my God, it'll shock you. Look at it. This is insanity. All right, look at it. Even back then itself, right, at 80 was already very high. Can you see that? It's very, very 89, okay? It's very, very high. But this time around, the CDS has shot up all the way to 177. Guys, this is double of what happened in 89 level. So think about this. What do you think will happen very soon? That is my reason why I'm pretty confident that it's just a matter of time. We're going to have a ultimate recession. And of course, price will go crazy and undeniable, right? You will have a lot of thoughts in your mind, seeing what should I do next and stuff like that. But all these things is not important if you don't understand the fundamental of the economy, right? Because now let me show you something, two very important charts. Now this is the real investors have been shoving money into cash. So that means that they have putting themselves a lot into cash. But you remember this, when you have a lot of cash itself, right? You can see that majority of the time, the market will pull back. That means that the market will actually pull back because of that. Because why? Because when the investors are not buying and the boys realize that there's no more interest on the retailers, they'll say, okay, that's it, let's drop the market. And the market will dive, go down until the price whereby the retailer thinks that it's good to buy, and then they buy. Now, are they because they are better or they smarter? Well, I think that some they are, but not everyone. Because take a look at this one now. This is the S&P 500 on the top. The dumb money is the one in blue, and smart money is the one. Smart money are the one in blue. The one that is the dumb money itself is the one in the red color. So what I'm trying to explain to you here is very, very simple. You can see that the dumb money, okay, are going into the market right now. And of course, the smart money, they actually got out back in January. So what happens is that the spread between them is far away, right? But you look at the market, wow, that's how the S&P actually collapsed. So all I can say is this. Some people say that is the stock market is the biggest casino. I will say yes, definitely. It's a yes, just how you play this game. So let's try this again, right? This is a peak of the S&P back then. And of course, you can see right now, the one in red is the dumb money, all right? And the one in blue are the smart money. Okay, so what do you see here, guys? There is a changeover. That means that the dumb money actually managed to sell off before the market comes off. Okay, so does it mean that dumb money are dumb? Not really true, but just sharing with you. But the main thing is this: as you can see right now, the spread between them is getting wider and wider. And when this thing gets so wide, right, as you can see earlier, right, the thing itself, you have to be very, very careful. Okay, I'll show to you. Where's that chart there? Okay, sorry, my bad. Okay, well, no, sorry. Oh gosh, there's some mechanical issue here. Okay, that means it's stuck here. Okay, it's not moving at all. Okay, so when the spread is big, that means that something may be happening soon, something may be boiling, something to be taking cautious. So now you can see this is the size between the DM and the SM. And now for us itself, right, we are about the same thing. So that's why I felt that, right, something pretty big will happen pretty soon. So traders, you need to be very, very careful. You don't want to be caught on the wrong side of the track and then after that lost your money, okay? All right, that will be all for today. I'll see you on the technical side. All right, that is where I'll tell you more about the market TA. This is Kel signing off. Have a great day. Bye-bye.